how to make money from property during a recession. Well, when a recession is on, generally it means there's a lot less money around, people are not really spending as much, people are being more careful, and all of this means that the overall business market, economy slows down, and this has a massive effect on property as well, because property no longer becomes a priority for somebody that's maybe looking to move house. They're thinking, well, maybe now's not the best time, we'll leave it to another time. And all of these things effectively are slowing down the housing market, and by slowing down, the prices start to fall. Now, how quickly they fall and how long they are down at a low point for, if you like, so how deep and how long that recession is for is going to impact the type of strategies you might be using. But ultimately, when we think about a recession, the property market is not static. It doesn't really move in this kind of way where the house prices just go up like this. What happens is over time, we start prices go up, then it might drop, then kind of go up and drop. But the general long-term trend is it will end up over here, significantly higher than where they started from. Generally, we have that belief, which is why we're interested in property, and that's why we invest in property. It's not only the money that we're making today, but by holding these assets for the long term, the profit that will equate or create even from the increase in value over time. Now, when the market starts to slow down, generally we'll get signals or we'll get signs of what's going on, so we can start taking steps to be careful that we don't get our fingers burnt. So, for instance, when we look at last year, the prices were very high in the summer. And what happened is that every time a property would come for sale, there'd be a rush of people trying to purchase that property. They'll push the price up. One person will get it. The other people will go off then trying to find another property. But then as the market started to change and it started to slow down a little bit, then there was a little bit more uncertain whether people should still be doing that. And when we look at the market today, what's happened is there's way fewer people actually looking to buy. Interest rates have gone up quite significantly. That also means people's ability to be able to fund higher value purchases is now less than it was before, and all of these things are pulling the market back. So we want to be looking for the signs and signals when a market is likely to slow down, so that we can be aware, so we're not jumping to deals that we might get our fingers burnt on. So for instance, let's say you are flipping property, you're going to add value and bring it to the market and sell, and also at that time the value of property prices are going up as well, the value, and then the profit that you can make from that will be higher. So not only the works that you've done, you're making a profit, but also because the market's going to make a profit as well. But actually, if the market slows down and goes the other way, the increase in prices that you were anticipating as all additional bonus profit, if you like, that will disappear. And plus, if the prices start to fall, what you'll find is you'll make even less money than you were initially anticipating. And depending on how much of a fall happens in the market, it could be that you may be even losing money. So when there's signs that the market might be slowing down, we want to get out of those type of deals much quicker. So last year, when I was selling a number of properties, and one of the flips, for example, that I was selling, we could sense that the market was now beginning to change. All the signs and the signals were there that the market's going to slow down. So I was thinking to myself, if I list this property now at a high price, I'll have a lot of people that will be interested in that particular property. However, when they commit to buying it, we're going to have to go through the normal mortgage process. That's going to be, and by the time they get to complete, that could be 2, maybe 3, even 4 months down the road. And by then, I know the market will have slowed down. And at that point, before the person actually completes a transaction, they might start getting nervous. They might pull out of that particular deal because the market's changed. And then I've got to go back to the market, find a new buyer, and we could be in the same position again. So that could be 2 potential deals that could fall out of bed because the market's falling and the prices are falling and things are going to take quite some time. So what I decided to do was do what I call a completion race, where we would put the property up for sale and it was the first person to be able to reach a point of completion. And clearly that really mostly appealed to those that were buying for cash, but also even for mortgage buyers, it demonstrated it is possible to turn these things around quite quickly. And what you had is a race for a number of people trying to purchase a property with only one winner, which is the first person across the line, as it were, who was able to exchange contracts. And the reason we were pushing for that, we accepted a slightly lower price and encouraged people to go down that route because we wanted to get out the deal fast. We didn't want to be sitting around when the prices are starting to fall. Although recessions, people can be fearful, you've probably also heard the term that more millionaires are made during a recession than any other time. And that's exactly for the reason because most people are fearful. So they miss out opportunities, they batten down the hatches, they're really scared to be able to go out and make decisions because there's a huge amount of uncertainty. But uncertainty creates opportunity. That doesn't mean that we jump into silly deals where we might get our fingers burnt. We've got to be cautious but it will probably present more of an opportunity. So for example, let's say house prices are falling. Let's say the typical value last year was £100,000 for a property, and maybe today it's £90,000, a current value. Well, actually, if you're looking to buy, the house price might still fall. There'll be more people that are maybe willing to accept, say, £70,000 even in that situation and that example, in order to be able to move on, get that deal done, whatever it might be. It could be other financial difficulty. It could be they want to move into a different property. It might be they're immigrating, whatever it might be. There are more people that are motivated to be flexible on a lower price just to be able to get the deal done. So in that case, if we're purchasing at £70,000, well, when the market recovers again, let's say it's 2 years or 3 years and it gets back up to £100,000, well, actually, we've profited £30,000 just by doing that deal and sitting on it. And we'll make maybe rental profit during that time as well. So that's an example of where, because people are fearful, there's fewer buyers in the market, you will have better and bigger opportunities to make money. Hey, if you're enjoying these Saj daily videos, then what I'd like you to do is click on my face over here to subscribe to the channel, and also click on the bell in order to get the notifications when these videos are being released. Then what to do next is click on this video here, and I'll see you over here on this video next.